Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. The great time of year to be an investor. It's a great time of year to be a consumer. Overall, everybody is in a much better mood. We're all starting to get out into the malls. We're starting to get out and do our holiday shopping in the United States. They're preparing for a long weekend, Thanksgiving long weekend. And I know I'm talking to a few of my friends down south. They can't wait to break for the Thanksgiving long weekend. So everybody is in seemingly a much better mood. And as we get closer to the holidays, I think even more so, people get more cheerful as we get closer to the holidays. And the market, for that matter, is in a good mood usually as well this time of year. More often than not, we do see a lot of gains in the months of November, December, and even into January, which we'll touch on a little bit later. However, investors always have questions regarding the market, even during these terrific times of the year, these holiday times. And as always, we're going to try and answer a lot of the questions that I've been asked over the last couple of weeks on our show today. And on our show, these are the topics we're going to touch on. We're going to start off with our top 3 things to consider over the next 10 business days. And usually we don't start with that, but today we are, because one of the top things to be mindful of is a topic that everybody's been asking me about over the last couple of days, and that word is tariffs. So we're going to touch on that in our top 3 things. Mind the Canadian and US interest rate gap. What do we mean by that? Well, the Bank of Canada rate versus the Fed funds rate. There is a pretty wide gap now between the two, basically almost 1 full percentage point. We're going to talk about what that means and what that means for investors and their portfolios. The Prime Minister announcing GST, HST temporary cuts and a $250 rebate check to come to those that worked in 2023 and made less than $150,000. We'll talk about that. Is this a good thing for the economy? And unfortunately, who is being left out? Who's upset about this and would like to see this slightly changed? Where should investors focus now, especially since the US election is over? What should investors be looking for over the next couple of months as we head until the final days of 2024? Bitcoin. Bitcoin has surged to almost $100,000 for one Bitcoin, US dollars, that is. Unbelievable. I can't believe where Bitcoin started the year and where Bitcoin even was on the day of the election back on November the 5th. It has climbed tremendously, and can't help but to talk about Bitcoin. It's been a question I've been asked a lot about over the last couple of weeks. Quick hits, the segment where we talk about 3 ideas, 3 things that have been in the news a lot lately that I will touch on very quickly. And last but definitely not least, your questions. If you have any questions during our show, please put them in the chat boxes, and I hope to get to some of those questions today. If I don't, I hopefully will answer them over the next couple of weeks before our next show, and at the very least, we will answer them on our next show if we don't get to them over the next 10 business days. So without further ado, let's move on to our first topic. So here we go, top 3 things that individual investors should consider before you make your investment decisions over the next couple of weeks. And as you can see, Trump commentary threatens 25% tariffs on all goods coming in from Canada and Mexico. This has caused obviously quite a stir up here in Canada and even in the US. Watching some of the US media, they're talking about it extensively as well, because if you are importing goods from Mexico and Canada, which obviously they do quite a bit of in the US, this is going to lead to higher prices, potentially higher inflation down the road. So we're going to talk about that. Definitely something to consider before you make your investment decision. Latest economic data to watch. We got some important data today out of the US, PCE, personal consumption and expenditures, as well as the latest GDP number, growth numbers out of the US. We're going to compare those to what we're seeing here in Canada. Canadian GDP comes out in the next few days. So we'll be able to see an updated GDP number there as well. And lastly, data coming out next week will be employment data. Next Friday, we will get employment numbers, jobs numbers out of the U.S. and Canada, I believe, as well. And our third topic to consider before you make your investment decisions: Canadian bank earnings. We're going to hear from our largest Canadian banks beginning of December. What are we anticipating? How good will these earnings reports be? So let's move on to our first topic, the Trump commentary and the threat of 25% tariffs on everything that's coming from Canada and Mexico. And obviously, this is something that will affect certain segments of our economy a lot more than others. Manufacturing, any manufacturing business that obviously exports to the United States, things such as energy, cars, trucks. It was interesting to see that energy is at the top of the list, followed very closely by autos. I think coming out of Mexico, GM does a lot of production out of Mexico, bringing those cars into the U.S. from Mexico. I believe when the tariffs were announced, GM stock was down over 8% that day, just the other day. Our first chart here clearly shows how much the United States imports from Mexico, China, and Canada, because even China, there's talk from President-elect Trump that they will increase tariffs on Chinese goods another 10% on top of the tariffs that former President Trump put on in his first 4 years of being in office. I know President Biden did not change that, even though he was quite negative when he took office on the Trump tariffs. He kept those tariffs in place. Well, now President-elect Trump is looking to put another 10% on Chinese goods coming into the United States. So you can see here how much, looks like Mexico is the leader out of the three countries. Interesting enough, used to be China. Mexico is getting close to 15, 16% imports into the US. China is somewhere at around, let's say 12, 13%. And Canada looks to be right there with China. So they get a lot of imports from those three countries. And, many people say this is just a bargaining tool. Tariffs are just the starting point to negotiate. A lot of people think that these tariffs will not be placed on Canada and Mexico, maybe not even China. But I think you got to take President-elect at his word that he may put these tariffs on. I guess it's a matter of let the negotiations begin. I know we've heard that our prime minister has been in talk with President-elect Trump. And according to Prime Minister Trudeau, those talks have gone quite well. So depending on what President-elect Trump wants from Canada, I believe he wants to see immigration, people crossing the border illegally stopped, drugs coming across their borders stopped. I know he's been upset in the past with respect to the dairy industry, lumber industry, many industries that obviously cross border that the president-elect is not happy with and wants to renegotiate some of those contracts. The USMCA that was created when President-elect Trump was in office the first time, he is saying that a lot of it will be maintained, but he wants to tweak it a little bit because certain things have definitely changed. Our next illustration or chart is Canada's exports to the United States. And you could see here in the last 12 months, energy, by far the #1 export to the United States, and obviously sector of the market that will be affected by tariffs, followed by, there you have it, cars and trucks, consumer goods, metal products, pulp and paper. There is your lumber, chemicals, machinery, agriculture, electronics, planes, boats, and trains. A large number of industry. It's not only these industries that will be affected, but anybody that supplies to these industries. So if you are an automotive parts maker, such as Magna, for example, you could see your business being affected, right? If you supply parts to the automotive industry, then definitely you will be affected by the latest tariffs. If you supply anything to the energy industry, and we know many companies provide different products to the energy industry, you will be affected as well. So tariffs, the talk about tariffs, we're going to have to keep a close eye on what happens over the course of the coming few months. If there are any other indications as to what the president-elect, former President Trump, wants and says, I think that's going to be very important before you make your investments over the next couple of weeks, and even beyond that, I guess right up until inauguration in January, and even probably into February as well. The next idea or point I want to focus on before you make your investment decisions is the latest economic data. And we always have this topic here because it is so important. And I guess the first one and the first chart we have to focus on is PCE. Keep in mind, this is the preferred measurement for inflation by the Federal Reserve. It leans a little less on real estate versus CPI, which has more real estate as a component. And you can see here that it has begun to tick higher once again. You see the core PCE, which is your blue line, moving higher to 2.8% based on this morning's numbers, and even the headline number moving up to 2.3%. This was higher from as low as 2.1% recently. So we're starting to see a little bit warmer inflation, more money being spent. We had actually some income numbers that were really, really strong this morning out of the US. People are definitely earning more, I guess, through their jobs. Spending wasn't higher, but it looks like they're saving money. And I guess if you're a retailer in the US and maybe even here in Canada, perhaps you're actually licking your chops, because the hope is that for these retailers, that these individuals are going to, the consumer is going to start to consume over the holiday season. And perhaps they've saved this money for the Thanksgiving and Christmas shopping spree. The next point I wanted to get to is our next chart, which is a chart on GDP. And we also received GDP numbers out of the US, and their number, or their second reading for the third quarter, was 2.8%. Very strong. This coming off a reading of 3% in the second quarter and just 1.5% or 1.6% in the first quarter. So very strong readings. And this tells, or should tell, the Fed that, well, maybe they don't need to act as quickly as many anticipated they would have to. Back in the summer months when we started to see unemployment tick higher in the US, GDP was kind of floundering a little bit. We were wondering if the Fed would cut aggressively in the fall and leading up to the end of the year. And really, they have cut. But I think the commentaries we're hearing from the Federal Reserve and the Fed governors, perhaps they go one more cut in December, on I believe it's mid-December that they have their meeting. And then for 2025, they may not cut as quick. They may take their time, maybe cut only once or twice, maybe a quarter point each time. So based on GDP or growth in the US, based on jobs, based on the consumer spending and what the consumer and how the consumer is faring, I don't think Federal Reserve has to cut rates as quickly as we do here in Canada. And one of the reasons why I say that is, look at our next chart, Canadian GDP. And we go from seeing numbers in the high 2 to 3% range to seeing numbers 0.5, 0.4. These are obviously a lot lower. We're on pace to probably do somewhere in the vicinity of 1.5% growth this year in Canada, whereas in the US, they're probably going to come in 2.5, 3%. So they're about 2 times larger, or their growth rate is about 2 times more than what we're doing here in our country. And that lends itself to why the Bank of Canada has been as aggressive as they have in cutting rates, into stimulating this market. And going forward, we'll have to see what happens with respect to what the Bank of Canada is now seeing the federal government doing with the rebate checks and the cutting of the GST, HST. How will that affect things? How will that affect inflation? And a lot of people are saying that the Bank of Canada might have to slow down what they wanted to do originally because of what Prime Minister Trudeau announced recently. The third point I wanted to touch on before, again, you make your investment decisions, and this one in particular affects many Canadians. And these are Canadian bank stocks, Canadian bank earnings. We're going to start to get our Canadian bank earnings in the next week. And for the most part, I think expectations are sort of tempered. I think coming into this earnings season, you have a banking sector that is slightly overvalued. At the very best, maybe fairly valued. You're looking at Canadian bank stocks trading at a multiple of about 12 times forward earnings. Historically, those Canadian bank stocks were probably in the 10 and a half, 11 times range. We're hearing about the consumer, that the consumer is a little more tapped, that they're not keeping up with their credit card payments and their unsecured debt payments. And so, what are we going to see from the loan loss provisions that these banks set aside, the money they set aside for bad debt? Many are fearing that we could see more money set aside. On the flip side, or I guess on the positive side, net interest margins. We're hoping to see, and we're anticipating a good number. And keep in mind, net interest margin is the difference, or the gap, or the spread between what banks pay on their GICs and, let's say, high interest savings accounts, and what they charge you for loans. And that gap has widened a little bit over the last little while. So banks benefit from that based on what they charge and what they pay. Net interest margin, the banks should, I think, benefit from that. We'll see what happens in the wealth management area. I'm expecting good things there as well, as the stock market has fared exceptionally well over the last quarter. So I think banks can be rewarded or see some good gains in that area. But overall, we don't anticipate any dividend increases. If we get those, that would be a bonus, because I don't think it's anticipated. And again, it just depends on which bank you look at. And we have charts on our 5 major banks, Royal Bank being our first chart. Royal Bank is probably one of the more expensive banks. The one bank that I no longer continue to buy for individual investors or recommend to buy. It is the strongest bank. It has been the strongest performer. And probably the most expensive bank. Shares are trading at, 13 times forward earnings, which is on the high side. But once again, we're expecting good things out of the bank. Again, lending will be a topic. We'll see what Royal Bank says. They're one of the best lenders in Canada. Next bank stock, and probably the second best performer in Canada, is CIBC. And again, you look at a chart of CIBC and you go from the bottom left to the top right. Fantastic stock, trading near or at all-time highs. And if you've owned CIBC this year, you've done exceptionally well, 30-40% returns. It's been a fantastic run for CIBC stock over the last 12 months. Next bank stock, Bank of Nova Scotia. And as I've said on many shows before, Bank of Nova Scotia has undergone and is still undergoing a restructuring. New CEO Thompson there, and they're really focusing on efficiency, being more efficient with what they do, the type of businesses they enter in, where their businesses are, getting out of businesses in certain countries of the world that are not doing well, that are not efficient, and moving more into areas such as the United States. So we've seen a restructuring. Recently, I saw an actual buy rating put on Scotiabank. Scotiabank is trading at 52-week highs, not all-time highs, but definitely 52-week highs. And again, if you've owned shares of Bank of Nova Scotia, you've done extremely well. TD Bank, our next chart, probably the only bank that has not done well this year. And as we know, that is because of their money laundering issues down in the US. We've seen their bank stock pull back. But at a 5% dividend, I think it's worth to take a look at. And last but not least, Bank of Montreal. Bank of Montreal has done really well, a little more volatile than the other banks because they had some credit issues earlier on this year. But again, I think I was on BNN not too long ago, maybe a few months ago, and I said, Bank of Montreal is probably the bank you may want to purchase because I think those credit issues will be left behind. They will they will get through it. And that's exactly what happened. And Bank of Montreal is back near 52-week highs once again. So I think overall, as part of what investors should be focusing on over the next couple of weeks before you make your investment decisions, Canadian bank earnings, most definitely. I think you want to look at the economic data. A lot of it has come out already. Focus on jobs next Friday. And definitely, most definitely, that's the topic everybody's talking about, tariffs. What will the new administration place tariffs? Will they place tariffs on all Canadian and Mexican goods coming into their country? And if so, how will that affect our investments? So there definitely is a gap between where interest rates are in Canada and the US. And I've been getting a few calls and questions. How far can they diverge? How can they be more than, let's say, 1 full percentage point difference between the Bank of Canada rate and the federal funds rate, the Fed funds rate in the US? They're about that right now, maybe 75 basis points in that range. If we cut rates at our next meeting and the Fed does not cut rates, well, there you'll have it. It'll be a full point difference between the two. And what does that do for our economy? What does it do for our dollar? What does it do for inflation? My opinion, our dollar will continue to weaken. And you couple that with the potential tariffs being levied by the US on Canadian goods, and our dollar could weaken even further. We actually saw it go below 71 cents recently, and it has peaked back up above 71 cents today, 71.3 cents last I checked. But the other day it was below 71 cents for the first time in a long time. Could we see a 69-cent dollar if we continue to cut rates and if the US were to place tariffs on all goods coming from Canada? I think it is quite possible. First chart we have here shows that Canada's annual inflation rises back to 2%. And you can see it here. It shows here that our interest rate now, 3.75%. That is the Bank of Canada rate. You see there, the CPI at 2%. And overall, still tells us we have some cushion there to cut rates. Once upon a time, the inflation rate was double, or the Bank of Canada rate, I should say, was double the inflation rate. That is no longer the case. If we cut a quarter point, I think 50 basis points is probably off the table now. But if we cut a quarter point to 3.5%, you're starting to look now at 1.5% difference. Perhaps we cut a couple more times early next year, and that gap or cushion between the two starts to dwindle. And as I said, if we are aggressive, the Bank of Canada is aggressive, and the US Fed is not, we could see ramifications, or we could see things play out in the currency market, in the inflation situation, and in the investment market, in my opinion, as well. Our next chart here shows the Fed funds target rate, and you can see here it is a range of 4.5 to 4.75. So individuals will say that their rate is somewhere around 4.625%, well above our rate. And we say, well, what does this mean? Well, look what it's doing to our currency. That is our next chart. Look how much our currency has deteriorated. Canada versus US spot exchange. Look at that slope down. It is probably the opposite of what we'd like to see. We'd like to see our dollar somewhere around 74, 75 cents. That is probably the average. If you go back over time, probably see an average between 73 and 75 cents. We have not seen it in that above 75 cents in quite a while. And the difference in interest rates and now plus the tariff conversation is definitely affecting our exchange rate, which is not good, especially if you want to take a trip to the US, especially if you are importing goods from the United States. That hits you the hardest. It increases the cost of goods that you bring in to build your products to sell here in Canada, and eventually, if those products and pieces that you bring in to build, if that is increased significantly, that will reflect on the bottom line pricing, and therefore we will see more inflation here in Canada. A great chart that we have, and it's one of my favorite charts for the week or for the show, and that is the rate divergence. And you can see here when the rate divergence was at more than a full percentage point. You see in the mid 90s, 97-ish, we saw a big divergence between the Fed funds rate and the Bank of Canada rate. You also saw that around 2000, 2001, also 2006-7 timeframe. And we really haven't seen a little big divergence since then. And now we're starting to see a little bit of a divergence. As you can see, the forecast going forward into 2025 is a bit of a divergence. Fed funds rate looks to be higher, and Bank of Canada looks to be a little bit more aggressive in cutting rates. So overall, we got to definitely keep an eye on the gap in interest rate policy between the Bank of Canada and the Federal Reserve. I think the Bank of Canada is definitely keeping an eye on it, and it's something that I know importers are keeping an eye on, and investors should keep an eye on as well. Another hot topic for our discussions, and there have been a few over the last few weeks for sure, is this whole idea that I guess a few days ago now, Prime Minister announced a cut in HST and GST on certain products that we buy, or if we go to restaurants, we won't have to pay GST, HST. He also announced the $250 rebate check that will come in the springtime to those that worked in 2023 and had an income of less than $150,000. Sounds pretty good. I know for some, they were a little upset by this. One of the groups that I guess was most upset were seniors, right? Seniors don't work, and therefore we're exempt from this $250 rebate check. We've definitely heard from seniors, and I know the Prime Minister has addressed it, saying that he does a lot for seniors, and this was to focus on a different segment of the population. But seniors definitely were not happy. Also, retailers, small retailers, small businesses, mom and pop shops, what are they going to do with this new removal of GST, HST? Their point of sale, their cash registers, however they actually charge the consumer when he comes into the store, they're now going to have to, I guess, update their software to not charge the HST, GST. And then 2 months from now, they're going to have to adjust once again. What are the costs involved in updating their point of sale software? So I know they had some rumblings there as well. And I guess overall, there's been a lot of talk from economists, and we actually have a couple of quotes I'll get to in a second. We can show the first one. They're talking about how the actual rebate check is going to have more of an effect on the economy than the HST, GST removal will. It could spur on more spending, which could spur on a little bit more inflation in the months of February and March. And the removal of HST and GST actually could bring down inflation initially. So it's bring down inflation, and inflation may go a little bit higher in the springtime when those checks get sent out. But the effects will probably be, as most people believe, very temporary. We could see GDP go up a little bit because of what's going to happen, and then come right back down once again, because we know that growth in our country, as we've seen on the charts just a few segments ago, has been very, very low. And the other thing that I've been hearing about from some merchants, some retail shops, is that this HST, GST a removal of it doesn't take place until after December 15th. So does that mean that people are going to prolong their buying for the holidays? Are they going to push out their buying to after December 15th? If you do that, you're only leaving yourself 9 or 10 days before the holidays. So is there just going to be this massive retail spending crunch the last 10 days before Christmas? So a lot there to parse through, and a couple of commentaries here. And the first one is from Doug Porter, chief economist of the Bank of Montreal. And he says it's important to point out just how meaty this is. It's quite a substantial move, and it's important to note that the much bigger impact here will not be the HST, the high-profile GST holiday, HST holiday. It's more about the rebate checks. And when you combine the rebate checks with the provincial rebate checks that, for example, province of Ontario is also sending out. Doug Porter says the money is likely to offer a significant boost to incomes and consumer spending at the start of the year. This is now actually working in the same direction as the Bank of Canada, and it's going to be relatively short-lived. We could get some pretty mild inflation reading in December and January, and then a kind of a nudge back higher in February and March. So there you have it. Economist Doug Porter from Bank of Montreal talking about the effects of what the Federal Reserve is, not Federal Reserve, federal government is proposing. A second quote here is by Royce Mendez, and he is from the head of macro strategy at Desjardins, managing director and head of macro strategy, said that the sales tax exemption will mechanically lower inflation, but the Bank of Canada will look beyond that. Central bankers will be more interested with the impacts on growth and underlying price pressures. The announcement should all but close the door to a 50 basis point cut next month. So he's maintaining that the Bank of Canada will probably just go a quarter basis point. That 50 basis points is no longer on the table for when they meet and announce their interest rate policy in December. So are these going to have a positive effect, these two announcements, for all of us? I think they can, but I think it's going to be short-lived. And I know in talking to tax strategists, to accountants, speaking to others in government, we much rather see a longer-term solution to taxes. Cutting HST, GST, in my opinion, isn't going to cut it. We need to lower income tax, especially if they're going to lower income tax down in the U.S. With this new administration, especially if they're going to cut red tape and remove a lot of the regulatory issues that the current government is facing down in the U.S. So get rid of some of the regulatory issues and cut taxes. That's going to spur on growth in the United States. We need to be as aggressive as they are. We need to cut taxes. And, we've heard rumblings that from the Conservatives that if they were to take over next year, that they would definitely look at cutting taxes going forward. So to me, cutting taxes, a lot longer term solution to the problem and a better solution to the problem than just giving out checks and cutting or removing the GST, HST for a couple of months. So what should investors now focus on? For such a long time, we talked about the election, what that was going to do to the stock market, how that was going to affect the stock market. A lot of people called me up, nervous, should we sell? And those that did, hopefully they didn't sell too much because the stock market had what we call the Trump bump, right? The Trump bump higher. We gave back some of that move higher, maybe a week and a half after, but we've managed to hold on to much of those gains that have now reached all-time gains, all-time new highs on the Dow, the S&P, the NASDAQ, and even the TSX. So what should we focus on going forward? Well, I think we have to focus on the markets again and focus on where we are, at what time of period or period of time we are at or we're in for the year. Where are we in terms of the calendar? And what are historical returns during this time of the calendar? First chart we have here shows the S&P 500 presidential cycle, year 4 monthly average returns, and it's a long-term chart. And you can clearly see for the last 100 years that the months of November and December during presidential election, markets move higher, significantly higher. And there's some talk that we could see maybe as much as 8% higher between now and the end of the year. I'd be happy with 3 to 5% higher. We know that the markets do well at this time of year, regardless if it's a presidential election or not. We have a chart showing you without a presidential election how markets fare. You pull that one up next, and you'll see that November, December, and January, markets move higher. It is the best 3-month period for the markets in the calendar for the 12 months. And if you want to add in October, which comes in soft, but usually leaves the month on a positive note, then you could add October to the mix as well. So that's what I think we need to focus on. I know the market is slightly overvalued, perhaps if you look at it on a PE multiple. I know a lot of stocks right now are moving higher, and we're starting to get a little bit nervous. How high can some of these tech names go? How high can some of the banks go? But I still believe there's a lot of good value out there in the markets on the S&P 500, TSX, the NASDAQ. I believe that if you're looking for good value, and if you're looking for value, and if they pay some dividends while you wait for that growth, I think that's always, and I've said this on the show many times, always the best recipe for success. So what to focus on? Focus on finding good value. Focus on the time of year that we're at. Focus on the holidays, the happy. People are spending money. The economy is surging forward. Retail sales are doing well. Consumer is spending, and that will be reflected in the economic data and in turn reflected in the stock market. And that's why we usually see the market move higher at this time of year. So I don't think our show would be complete if I didn't speak about Bitcoin, and getting a lot of questions about Bitcoin. And I have to be honest right off the top and say, to me, I just don't understand Bitcoin. Maybe it's an alternative to the US currency. Maybe it's an alternative to gold. Maybe, instead of owning gold, younger investors want to buy digital currency instead. You still can't walk into the grocery store or Shoppers or any retail store that I know of and take some Bitcoin and buy some clothing or buy groceries. So to me, it's just very difficult to understand why Bitcoin is having the success that it is having. Obviously, President-elect Trump, when he was on his campaign trail, spoke about Bitcoin, that he wanted to be, or that he wanted the US to be the Bitcoin capital of the world. And obviously, when he came into office and was elected, the surge we saw in Bitcoin really has been unmatched. The day that he was elected, Bitcoin was trading somewhere around 69,000 US dollars per Bitcoin. And recently, Bitcoin hit just under $100,000. And remember, the election was only in November 5th. We have a chart of Bitcoin that we can put up, and you'll see how much Bitcoin has surged. If you want to go back to the start of the year, Bitcoin at the start of the year was just over $43,000. And today, just over 90,000. Actually, Bitcoin is a little bit higher today, last I checked. It's very volatile, so not sure where it sits right now. But it was definitely in that 92 to 95,000 range. And many are predicting, based on more ETFs, more products to be offered to the investor, more talk about from the government, more talk about closed-end funds and opportunities in digital currency. The more it's talked about, the more we'll probably see Bitcoin go higher. And as I've said many times, from even a few years back, Bitcoin is not going to disappear. I felt it was here to stay. And many places around the world are starting to move more towards digital currency. North America, obviously, we are taking or accepting Bitcoin and Ethereum and other currencies at this point in time. Still not replacing our Canadian and US dollars, but overall, it is something that we need to focus on and keep in mind. It is definitely not for the faint of heart, and definitely a high risk investment. So if you're watching today and wondering, should I call Allan and ask him if I should be buying a Bitcoin product, an ETF, closed-end mutual fund, or whatever might be available? The answer is, can you handle the high volatility? Can you handle the high risk? Can you handle perhaps making 10% in a day or losing 10% or more in a day? And that is what you have to ask yourself when you start to look at whether you should be investing in Bitcoin or not. quick hits. Quick hits. I love this part of the show because I get to talk about three things. Three things that I'm sure many of you are watching or have seen on TV or have seen online through social media and perhaps other places. First one, or first quick hit that a lot of people have been talking about are Trump cabinet nominations. They've attracted a lot of attention, some more than others, but President-elect Trump has put into place, or at least put forward, many names that carry with it certain ways of thinking. And that has caused, definitely has caused the market to move. Google, I'm sure a lot of you have heard about Google or Alphabet, the parent company, and how they may be forced to sell their Chrome browser. The DOJ has said in the United States that they are a monopoly, that they cannot maintain this monopoly, that is Google or Alphabet, and they will be forced to divest of certain parts of their business. And they came out recently and said the Chrome browser is the business that I guess the DOJ wants to, which is, by the way, Department of Defense, Department of Justice, what they want them to do to be more, to open up the industry, to be more industry friendly, to obviously sell off that part of their business so that other businesses can get into the browser business. The third quick hit that I wanted to touch on, and I briefly touched on it earlier, is this idea of the S&P 500 predicted by some to rise 8% by the end of the year. That would be fantastic if that were the case. I'm not holding my breath on that one. To me, if we see a rise of maybe 3 to 5%, I think I'd be plenty happy with that, especially after the huge gains we've seen in the market so far this year. So let's move to our first one, the Trump cabinet nominations. And as I said, they're attracting a lot of attention. The most recent Treasury Secretary, Bissent, he was a hedge fund manager. And President-elect Donald Trump basically tapped him on the shoulder and said, we want you to be the Treasury Secretary. This gentleman is definitely in favor of tariffs, but he's more moderate. He says, we're going to use tariffs. We're going to use tariffs as a bargaining tool. Not necessarily are we going to just slap everybody with a 25% tariff, China with a 10% tariff. We're going to keep that in our basket and use it if necessary. So that was a positive. And because this gentleman was a hedge fund, I guess, I don't know if he's a guru, but well respected in the hedge fund community, the market definitely liked that. He's going to be pro-business, pro-investment. So that was a positive for the stock market the other day. We saw the markets move up on that effect. On the flip side, we saw the appointment of Robert Kennedy, and he was appointed as HHS secretary. So he's going to be in charge of health and food. And we know, based on what he has said in the past, he's not in favor of vaccinations. He is skeptical of vaccines, also very negative on some preservatives that go into food. So we saw on the day that he was announced, we saw pharmaceutical industry sell off significantly. And our chart that we have to show with respect to this, you could clearly see that the pharmaceutical, this is a iShares US pharmaceutical ETF. Look how much pharmaceutical industry fell when his appointment or announcement that the Trump administration was appointing him secretary of the HHS. Since then, the good news is it's rebounded somewhat. And, you know, Robert Kennedy has said a few times recently that he's not going to bash or be negative on the vaccines that are already being circulated in use already. But he's definitely going to be very stringent on any new vaccines that want to come to market. So anything that's been done in the past, I think the names like Pfizer and Merck and names like that should be okay with respect to what vaccines they already have going right now. But new stuff, that is where he will be very strict. And, you know, I think that most of us would want him to be strict about any new vaccines coming down the pipeline. So the appointments that Trump has made definitely have affected the markets. Second quick hit is regarding Google or Alphabet and the fact that the DOJ, Department of Justice, wants Google to sell off, divest their Chrome business. And why are they doing that? And if many of you are thinking, well, this is really, really tough. Well, our first and only chart, I guess, not our first, but our only chart here shows why. You can see here that Chrome makes up 66.68% of the market share worldwide, the browser market share. Safari, which as many of you know is from Apple, makes up less than 20%. So it definitely has a dominant market share. And, we've heard companies like OpenAI trying to get into more of the search business and all that. So there's definitely competition for Google, but the browser business, the Chrome browser, is definitely unmatched. And I know Google has said that if the DOJ forces them to sell off this business, that it will be bad. It will be bad for investors. It would be bad for the product lineup that Google presents to everyone, all of us. It will definitely hurt Google, which in turn will probably hurt many individuals that use search, Google search, the Chrome browser, which many of us like and use. I use it all the time as well. So we'll see what happens. The talk is that whatever happens probably won't play out for maybe as much as 1 to 2 years. Google is going to appeal anything that gets handed down to them, and that appeal will probably take quite a bit of time. The third hit, or the third quick hit that I wanted to get to today is this idea of the S&P rising 8% by the end of the year. We have a chart of the S&P 500. It is our last chart of the show, and it clearly shows S&P going higher from the bottom left to the top right. S&P's up quite a bit over the last year in that 25% range. It has been a phenomenal year, building on top of the 20 to 25% growth in 2023. It begs the question, what do we expect in 24? Well, I would be happy with a traditional rate of return, 8, 10, maybe as much as 12% on the S&P 500. If we were to get that kind of rate of return after the last 2 years, I would be just fine with that. And with respect to the end of this year, if we can get a bit of a Santa Claus rally, 3 to 5%, I'd be happy with that. I know a lot of people are aggressive with their predictions, calling for an 8% return. As I said, I'm not sure I'm in that camp, but if we do see that, that would be just gravy on top of a fantastic year that we've had so far in 2024. It's another part of the show where I take at least one question from the audience. We have actually a number of great questions. Some of them I've already answered in the course of the show. There's a question on tariffs. I'll take this question here. The Canadian dollar continues to drop and is now around 71 cents. What does this mean for investors? Well, it means that for many of us, if we're taking our Canadian dollars and going down into the US and buying US investments or buying investments around the world, in Europe, for example, it means we're buying a lot less. And a lot of investors are upset about that, of course, and worried about that. My opinion on that is, I think you have to go outside of Canada, and the currency exchange should not deter you from doing that. The hope is that the dollar stays within a range. If it's 71 cents right now, when you go to sell that, let's say US investment, the hope is that it's still within that 71 cent range, maybe plus or minus a percent or two. So yes, if you're going to go into areas or countries to make investments such as the US, you want to buy something that is going to make you a lot more than just a couple of percent. You want to go there if you see significant upside. And what I like to do is, if I see something that can make an investor 20%, 15%, that's the kind of investment returns that I think you can make down in the US. So a currency exchange of a couple of percent, if when you go to sell, it works against you, then I think it's definitely worth the while. So overall, don't let currency deter you from buying investments. Obviously, a weaker currency is going to make trips to the US more expensive. As I said earlier, imports, if you are a business importing product from the US or goods, it's going to make it a lot more expensive. And in turn, over time, could affect the overall inflation rate. So with that, I want to say thank you for everybody that tuned in today. Thank you for taking the time out of your day to join us. I want to say that we will be right back here in a couple of weeks, 12 noon Wednesday, the December the 11th. And until then, happy investing. Very hot in my office.